Thank you, Chairman Brown, and welcome to all of our witnesses. This January's volatility in the stock market understandably captured everybody's attention. We saw extraordinary trading volumes in GameStop and other stocks, and we also saw some brokers limit stock purchases during this period of volatility. So it's entirely appropriate to examine these events and try to understand what happened and whether any response is needed. However, I urge my colleagues and regulators to avoid any knee-jerk reaction to impose unnecessary restrictions and burdens on investors. We have yet to see any evidence of wrongdoing or that the regulatory regime failed to function as intended, and Congress and regulators should avoid new laws and regulations that could end up limiting investors' access to and choices in the stock market. One reason to tread cautiously is that new developments have made it a great time to be a retail investor. Today, a person of modest means can invest in the stock market at zero or minimal cost. Two developments particularly stand out: the zero commission trading platforms with no minimum account balance required, and a user-friendly trading technology such as mobile apps. Zero commission trading is the culmination of a decline in investor costs since the SEC abolished fixed commissions in 1975 and forced brokers to compete against each other. In the 80s and 90s, it could cost you close to $100 to buy several $1,000s worth of stock. By the 2000s, online trading sites offered lower costs, but they could still cost you $30 for a trade. Competition from market makers allows brokers, under their best execution obligation, to obtain a better price for investors than current market price, even after receiving a payment for order flow, and they can charge zero to investors. Similarly, new technology like app-based trading platforms make it easier to access the market, including buying through fractional shares. And it's not just Robinhood attracting new investors. The Wall Street Journal reported that 2020, despite the volatility, was a record year for new individual accounts. And these developments have, of course, contributed to broader investment in the stock market. According to the Federal Reserve, in 1989, less than one-third of U.S. households owned stocks. 3 decades later, in 2019, a majority of American households did. And the most rapid growth is among low and middle income households. And let's not forget about the millions of others, including police officers, firefighters, teachers, and other workers indirectly invested through pension funds. This allows everyone to share in the tremendous wealth gains generated by the stock market, which used to be available only to wealthy individuals and institutional investors. Despite these positive developments, some see the state of retail investing only in negative terms. Rather than celebrating the fact that it's cheaper and easier for average Americans to invest in the stock market, some claim that the market is somehow rigged against retail investors. So, to my colleagues who say that, I'd like to hear why they believe that. Does the retail investor not receive dividends like institutional investors do? Is the retail investor not entitled to best execution on trades like institutional investors? When a stock goes up in value, does the value of a retail investor's share not go up like wealthy individuals? Of course, the answer to all of these questions is obviously no. And if the market is rigged, then why did some hedge funds lose their shirts shorting GameStop while some retail investors hit pay dirt buying it? I'm also incredulous at the idea that it somehow hurts retail investors to have access to investing technologies that are inexpensive and pleasant and easy to use. Retail investing doesn't need to be expensive and miserable and difficult to experience, nor should we want it to be. I'd like to see more U.S. households have the opportunity to benefit from the financial gains that are available through the stock market. Your average American doesn't need big government coming in to limit her access to and choices in the stock market. The fact is, risk is a fundamental part of investing. All investors, whether they are small retail investors or big hedge funds, can gain or lose money by investing. But what we know is for sure, over time, long-term investors investing in U.S. stocks, it's the exact opposite of going to the casino. Investors win, and when you go to the casino, you lose. Investors in GameStop and a few other stocks took a lot of risk, but they represent a very, very small fraction of retail investors. And investors should understand that if they make a very risky investment, they might lose money. Those who bought GameStop at its high very likely lost money. I certainly hope they didn't invest money they couldn't afford to lose, but it's not the government's job to tell people which stocks they can and which they cannot buy. In my view, there is one action that regulators should pursue, and Chairman Brown alluded to this, and that's to finish the work that it started in 2004 for a faster settlement cycle, including same day cycle or maybe even real time settlement. A faster settlement cycle will reduce risks for clearing agencies because there'll be fewer unsettled trades and a reduced time period of exposure. And a faster settlement cycle will also require less collateral for clearing agencies, which may reduce margin charges and other fees that are inevitably passed on to investors. When the SEC moved to T+2 back in 2017, the SEC said it wanted to make settlement even faster. And last month, Ranking Member McHenry from the House and I wrote to the SEC asking that they follow through on this longstanding objective. Let me close by just repeating, I think Congress and the regulators should tread very cautiously here. We should want to make sure that all parts of American society can participate and share in the gains of the stock market, and we should avoid taking actions that would undermine that goal. I look forward to today's testimony.